During the day, we did distribute this question and wanted you to tackle it, to read through, understand the scenario and tackle it. We want to evaluate the current system of transfer pricing. Now, in our last class, we did cover features of a good transfer pricing. We did cover features of a good transfer pricing. Okay. That's what we covered. So, what are some of the features of a good transfer pricing? We spoke about the concept of autonomy. We covered the concept of autonomy. Remember? We covered the concept of autonomy. What else? Fair performance appraisal. We covered the concept of fair performance appraisal. And also we cover the concept of congruent.
I'm now busy here, Muntu. Let me also learn. Have you finished spreading your bed?
We covered the concept of congruence. We covered the concept of congruence. Now, when you look at this statement here, what can you pick from the statement? Already we can suspect something. These are reporting a loss. So when you look at this transfer pricing system, we may already argue that there may be a problem with this fair performance appraisal because all the profit has been taken there. Here there's a loss. All the profit has been taken there. So let's start giving you an idea of where the question is coming from. That gives an idea of where the question is coming from. In our evaluation, we can already suspect that there seems to be a problem here. The current transfer pricing system may have a problem, and this now will be confirmed. So now, let us go further and do a further analysis. Let us do a further analysis. Okay. So what is the current transfer pricing system that is being used? Let's pick it here. The current transfer pricing policy at L is as follows. Market prices for electrical components. Market prices for electrical components are used, as these are generic components for which there is a competitive external market. So let's do an evaluation. In an evaluation, we need to comment on the strength and the weakness. Is this okay? Is this acceptable? Can we have your comments, please? Can we have your comments, please? What do you say? What did we learn about transfer pricing? we are looking at the components for which there is an active market out there. So what can we say? This is acceptable where a component has got an external market. It is appropriate, acceptable, and good practice to adopt the external market price. Because an external market price is going to meet those characteristics of a good transfer price. An external market price is going to meet those three features of a good TP. So your evaluation is that what has happened here is acceptable. It is acceptable. That is what we expect. It's in line with our understanding of the features of a good TP. But what did we learn? Where you have adopted an external market price, what is it that we expect? We learned that we must adjust. We must adjust the external market price. Why do we adjust? To reflect the savings, that are going to arise because of the internal nature of the transaction. Is that the case here? Is that the case here? If the components divisions were to sell its electrical components externally, then additional cost of 269 would arise from transport, marketing, and bad dates. So the weakness in the system is that they didn't capture the savings in transport costs, marketing costs, and even bad dates. So your evaluation is that the step they took was acceptable because these are generic components with a competitive external market. However, the weakness is they didn't give any adjustment. There's an adjustment of 269 which would have been given. Which they have not given. The question said, do some illustrative calculations. The question was not about you calculating or preparing a statement. It was do some illustrative calculations to this so that you explain your point. You demonstrate your point. So it's just a demonstration or illustration to say what you mean. So for instance, in this case, what would we do? You can do an illustrative calculation where you can say 269, this figure here, they should have given a 269 discount. They should have given a 269 discount. So we're supposed to reduce that and reduce that too. And we're going to show what the impact will be. Secondly, let us go to the next one. What was the other transfer price? What was the other transfer price? Prices for housing components based on total actual production cost to the components division are used as there is no external market for these components, since they are specially designed for the L products. What is your evaluation of this? What is your evaluation of this? Did they do what is expected? Step number one, we are going to say where there is no external market for a component being transferred, the only basis for a transfer price is the cost, as the case was here. So in evaluating the transfer price used for the housing components, we are saying what they did was acceptable. However, what did we learn? We learned that it is better to use not the actual cost, but the budget cost. It's better to use the actual cost, the budget cost, or the standard cost. And not the actual. But what did they do here? They use the actual. So the weakness of what they have done here is that they use the actual. That's the weakness. The weakness is that they used the actual. That is one. Secondly, we indicated also that you need to give some profit of some kind. You can't allow people to recover only cost. You need to add a markup of some kind. Allow them to make something. Allow them to put a markup of some kind. Cost recovery alone is not fair. Cost recovery alone is not fair. It causes demotivation. And that is where the problem is. What do we mean? What do we mean? Let's come here. We have indicated that there's a problem here. Why did these make a loss? Why is there a loss and all the profit is here? Now the issue is, when they were transferring these items, which is the bulk of the work? Remember, if you say 8204 over 9761 times 100, this proportion of their work has carried no profit at all. And now you can see the explanation why there's a loss here. It's because the bulk of the product is being transferred at cost. So our argument is that they are supposed to give something here. We're supposed to give something. Now it's up to you can illustrate that if we give them a markup of 20% or 30%, what would happen? So now, with those points, let us see some possible illustrative calculations that we can show. Let us demonstrate some possible illustrative calculations. Okay. Let us show. I hope all of you can see my screen. So we have said, okay, electrical, let's remove that. So we have removed that. What is that? Well, these are internal savings. So we're saying this you must adjust, and we end up with that. The housing component. The housing component, we have identified that the use of actual cost is not in order. Why? There was a note here. Let's focus on the note. The components division has had problems meeting budgets recently. So these people are overspending with an adverse variance of 575. So the actual cost was above the budget. The actual cost exceeded the budget. That's what we see here. By how much? By 575. By this figure. So we're going to correct it ourselves. Illustratively, we want to demonstrate, illustrate. So we're going to make an adjustment for that. Then we have noticed that the bulk of their work didn't carry any profit. We're going to give them a profit. So we've come here. This we have removed. And that also we have removed. Then from there, what happens? We've got our, this figure here, remove that, we get that. I have given them a profit markup of 30%. We have said that if first we remove level expenditure so that you have got a budgeted figure, which is that one. Secondly, I have given them a profit of 30%. Therefore, now the total sales is 11,206. The area one was 9761. 9761. But after correcting these two figures, here remove the 269. Here remove the variance and add the 30%. This figure now, the revenue here has increased, has gone up. Here also, this cost will have gone up. So now we are transferring some of the profit from here. We are transferring it there. By doing what? Increasing the cost. Here, the cost is going up. There, the revenue is going up. By how much? Let us check now. Let us check. The difference between this and that is 1445. So what we are saying now is that there's an increase of 1445. So the revenue will go up by 1445. The cost will go up by 1445. So what happens now? You come here, you put revenue of 1445. Here you increase cost of 1445. In other words, you're going to remove 1445 here and put it there. So you subtract it here and you add it there. So what happens? The story has now changed. That plus 1445, 1367. That take out that. Now we are saying, illustratively, we can say that if they had followed good practice, these are not supposed to report a loss of 78. They're supposed to report that profit. These are not supposed to have an overstated profit. They're supposed to. These are simply illustrative computations. These are simply illustrative computations. Are we okay about that one? Your reaction,
Yes.
please.
Yes.
Okay. In the exam, we may not have the time for such detailed computations. No. What you can pick here is a principle that on this exam, we can be given a transfer pricing which is in place, and you are asked to evaluate it. So we're trying to illustrate to you one of the possible ways that we can look at what were the weaknesses, what were the strengths. And if you're asked to correct, you must be able to show some basic corrections. Somebody probably may just have mentioned this in their paragraphs in writing. You would have said that, well, we're supposed to make that adjustment and this adjustment. Even this 30%, you can simply just talk about it. That a transfer price based purely on cost with no profit, we are saying is not fair. And even if you didn't make any of these adjustments, you know, at your level, you're looking at a bigger picture, you are strategists. One could have just said, Mr. Perry, would I be wrong if I just focus saying, the mistake I've seen here is that there's no profit. So I'll just put a profit, a small profit there. Whatever small profit you put there, it will increase that and reduce that. That's your demonstrative, your illustrative calculation. But you saw where we started from. We started from by looking at this income statement, and we noted that why should somebody report a loss when there's internal pricing? It means there's something wrong. And we found where the mistake was. So please borrow the principle from this question to any other question. Why? Because our paper is about evaluation. We did cover yesterday in a Monday class that we need to be very careful with proposed or with the transfer pricing that companies are using, because it must have those three characteristics. Now there's a further proposal. Let's look at the next question here. Advise the FD on the impact of changing the transfer pricing policy for housing components as suggested by FD, and comment on the results using illustrative calculation as appropriate. Let's again go to what is this proposal. Okay. The transfer pricing policy for housing components would change to use variable cost to the components division, meaning currently they're using full cost. They're adding the electrical. They're adding, what are they adding? They're adding the variable cost and the fixed cost. That's what they're adding currently. Yeah. So now there's a proposal here. And the proposal is that they should only charge variable cost. They should only charge variable cost. So now, what is the effect? So the effect is you are reducing their sales further. You are further reducing the sales. Because now we are saying that you won't allow them to charge everything. They only charge the variable cost. What will be the effect? It will be worse. The effect will be worse. Because they're now saying that don't charge for the fixed cost. That's what they are proposing here. The FD is considering two separate changes. The transfer pricing policy for the housing components. So let us see, go to the housing component. This one, 8204. The transfer price. How was 8204 calculated? Earlier on, how did they cover 8204? This one. They come here, 6902 plus 1302. So they add these together, which is a variable cost and a fixed cost. So we add these. And adding this, you bring them here. Now we say you won't allow you to charge that. So here, they only be what? 6902. In other words, this sales has been reduced by what? By 1302. So it means that here the loss will increase by 1302. Here, the cost will reduce, the input cost reduced. In other words, the profit here will increase by 1302. So that will be your illustrative calculation. You don't need to go very far. This is your illustrative calculation. The profit will go down. Here it will go up. Now, we know that that's basically the problem of a TP, which is based on variable cost. A TP based on variable cost has a problem. Why? The problem is that in the transferring division, their performance will be understated. So the transferring division will have a problem. The receiving division, their performance will be overstated. That is what we expect. So our evaluation is that the use of variable cost will worsen or will make performance appraisal more unfair. The transferring division, the results will be worsened. The receiving division, their performance will be overstated. Is that okay, people, with our evaluation? Are we making sense out of it now?
Yes, sir.
You
done very well, sir.
Let us so there was in terms of the small computation here, this is how I showed it. Yeah, 1302. So now it will be that. So what will happen? This will worsen 1380. 1380. The loss. Whilst the profit will go to 4021 for the assembly. Is there anything you can carry home? The point you can carry home here is this. If you take a cost-based approach and you decide to use variable cost has serious problems. A transfer price where the transferring division only covers variable cost, there's a problem because their performance will be so low. Now, in the third part of the question, here is the wisdom that we get in transfer pricing. If there's a lot of fighting on transfer price, because remember, transfer price is just an internal arrangement for accountability, for responsibility accounting purposes. There's no additional revenue per se that we are generating. So if we have a transfer pricing system and you notice that it's causing too much fighting, we are spending a lot of time, too much fighting. Too much politics. What is one option that you have? Or what may that be saying? It could be that your responsibility centers really have been wrongly designated